Hi, this is Kurt Kringelis, Head of Credit Strategy for Voya Investment Management. I would like to take a few minutes to share with you a brief update on the performance of the fixed income markets. The fixed income market rally failed to hold up in July despite a healthy second quarter earnings season. While the month started off on a positive note, excess return performance ultimately faded across the fixed income markets. The month ended on a particularly poor note for the high yield sector. Solid U.S. economic data finally led to renewed uncertainty surrounding the timing of interest rate hikes by the Federal Reserve and negatively impacted risk sentiment in the high-yield asset class in particular. Renewed tensions between Russia and Ukraine, as well as the conflict in the Middle East, also weighed on sentiment and helped erase the initial positive start for the emerging markets. Within the U.S. investment-grade corporate market, most industries outperform the market on the month. However, when industry weightings are taken into account, roughly half of the market traded in line with the index, given the large weight of the financial and utility industries. The energy industry gave back some of its strong performance in June as oil prices retraced much of their gains during the past 2 months. The basic industries delivered in-line results after a market-leading performance last month. The communications industry remained an outperformer, while the consumer cyclical and capital goods industries continued to lag. On a year-to-date basis, the performance pattern continues to hold relatively steady. The communications industry continues to add to its strong performance early in the year. The cyclically sensitive basic and transportation industries also continue to perform well. The excess return distribution is relatively compressed across the bulk of the market, as might be expected during a relatively low volatility year. The consumer-oriented industries remain the notable laggards, as low spreads and a continuation of shareholder-friendly activities have weighed on results. Our tactical outlook for the corporate market remains relatively neutral. July ended on a weaker note, and we would view any meaningful spread widening as a buying opportunity. Adjustments in market expectations related to the Fed's path for monetary policy appear to be contributing to a new round of volatility. In our view, incoming data remains healthy and is supportive of the continuation of the current credit cycle. Geopolitical risks have risen and need to be monitored, but at this point we do not feel that the tensions have risen to the point of threatening our outlook, but that could certainly change. The summer often coincides with weaker credit market performance, but if geopolitical events do not get out of hand, we expect spreads to ultimately end the year in line with or tighter than current levels.